cold open, shock reframe. This wasn't fundamentals. With that context in place, it is important to say this clearly. What you just watched in the market did not come from sentiment, earnings, or headlines. It did not come from fear or optimism. It came from forced behavior. It came from rules colliding with leverage, balance sheets adjusting under stress, and liquidity being pulled back at the exact moment it was most needed. Japan is not the story. Japan is a pressure point inside a global funding system that moves capital, whether anyone agrees or not. And when that system shifts, the market doesn't negotiate. It enforces. The market just showed its teeth. Nausea and tension are rational responses to liquidity events because your nervous system recognizes non-human behavior. In a minute, I'll show you the one signal that decides whether this becomes a crash or a containment. Later, we'll map the paths forward. What actually happened? The mechanics trigger. Once you frame it that way, the mechanics become easier to see. A large-scale capital exit is rarely a choice. It is balance sheets repositioning under constraint. And when a sovereign funding source shifts, it does not stay local. It ripples through the global collateral network because sovereign bonds are not just investments, they are plumbing. They are pledged, rehypothecated, swapped, and used to support leverage across currencies and asset classes. If that foundation moves, everything built on it has to be recalibrated. When Japanese yields adjust and hedging costs change, dollar liquidity conditions change with them. Carry trades tighten, cross-border hedges reprice. The cost of holding risk rises quietly at first, then all at once. Bonds feel it through funding spreads. Equities feel it through dealer balance sheets. Foreign exchange feels it through margin and basis. Metals feel it through volatility, sensitivity, and collateral demands. This is how a rate move becomes a multi-asset event. Fact, margin systems are designed to react to stress, not predict it. Interpretation. Once thresholds are crossed, slow pressure converts into immediate motion. Algorithms are not emotional, but they are constrained. Dealers are not directional, but they are capital limited. When volatility expands, inventory is reduced. When inventory is reduced, bids retreat. At that point, price is no longer negotiating value. It is locating cash. That is why this didn't drift. It snapped. And the violence didn't come from opinions. It came from who was forced to act. Next, I'll show you why forced selling always feels personal, why it felt violent, forced selling and thin liquidity. That brings us to why this move felt violent rather than merely volatile. Violence in markets is not speed alone. It is speed combined with absence. Absence of depth. Absence of counterparties. Absence of choice. The first sellers were not discretionary. They were leveraged funds forced to reduce exposure as volatility lifted their capital requirements. They were hedged institutions watching correlations break, and risk models demand shrinkage. They were volatility-targeted strategies mechanically cutting positions because realized movement crossed predefined bands. None of that is opinion. It is rule execution. Thin liquidity zones form precisely because nothing has happened for a long time. Extended calm trains dealers to run light inventory. It trains algorithms to expect continuity. It trains risk systems to compress buffers. When stress finally arrives, it arrives into shallow water. Order books that look deep during normal hours evaporate as soon as balance sheet costs rise. Bids step back. Offers jump. Air pockets open. Gaps replace trades. Stops and margin rules are the accelerants. A slow drift lower can feel survivable. But once key thresholds are breached, forced orders stack on top of forced orders. Selling begets lower prices. Lower prices trigger new requirements. Requirements trigger new selling. What looked like a move becomes a cascade. This is what people experience as being hunted by candles. It is not predators, it is procedures. This is where the phrase psychological warfare by mechanics applies. Not because someone is targeting emotion, but because the structure of modern markets is designed to push discomfort into the fastest possible feedback loop. Nausea, tunnel vision, and the urge to watch every tick are biological responses to environments where agency disappears. Your nervous system recognizes that this is not human conversation. And before we talk about where moves like this often exhaust, we have to separate what is measurable from what is merely narrative. Facts versus interpretation. The credibility ladder. To stay oriented inside environments like this, you need a simple internal structure. Facts on one side, interpretation on the other. Facts are what changed. Interpretation is what we think those changes might lead to. Most damage happens when those two are blended too early. Fact. Volatility expanded abruptly across multiple markets. That tells us regimes shifted. Fact. Cross-asset correlations spiked. That tells us diversification temporarily failed. Fact. Funding conditions tightened, collateral sensitivity increased, and liquidity pulled back at the dealer level. That tells us balance sheet cost rose. Fact. Margin responsiveness increased across risk assets. That tells us forced behavior became more likely. Interpretation begins only after those are acknowledged. Historically, This cluster of facts often precedes periods where markets stop rewarding reaction and start punishing it. It often precedes sharp rotations between stability and stress. It often precedes wide narrative dispersion, where headlines multiply faster than liquidity. That is where media framing frequently misleads, because stories are built to assign motives, villains, and endpoints to systems that are simply repricing constraints. Discipline is not emotional suppression. It is structural protection. It preserves both capital and psychology by preventing premature certainty. And once facts are separated from stories, something else becomes more important than any opinion, where behavior actually changes. Because the next section is where the battlefield becomes visible. One zone on the chart now carries more information than 100 headlines. The decision zone, key levels and behavior. Once facts are separated from stories, the market simplifies. What matters now is not what people think should happen, but where behavior actually changes. That is what a decision zone is. It is not a mystical level. It is the region where forced behavior either intensifies or begins to exhaust. It is where balance sheets stop retreating and start testing, or where they fail and pull back again. Mechanically, this is where dealers decide whether they can re-expand inventory or must continue to shrink it. It is where hedgers decide whether exposure can be maintained or must be neutralized. It is where funds discover whether volatility is stabilizing or still destabilizing. Stabilization does not look like rallies. It looks like spreads narrowing. It looks like bids returning in size. It looks like price moving without immediate follow-through. It looks like volatility compressing after expansion. That compression is not calm. It is pressure. Rejection looks different. It looks like shallow bounces. It looks like volume that moves price too easily. It looks like levels that fail without struggle. It looks like volatility staying elevated even when price pauses. Chop inside a decision zone is not boredom. It is information. It tells you whether liquidity is rebuilding or still retreating. This is why the next 14 days matter more than the last 14 hours. Violence resets positioning. What follows determines whether the system digests it or multiplies it. Aftershocks. Markets often compress before choosing their next leg, because participants wait for margin frameworks, funding conditions, and dealer capacity to reveal themselves. And this is also where screens alone become insufficient, because while paper trades negotiate in microseconds, physical markets respond in days. In a moment, we step outside the screen. One real-world signal is already diverging. Paper versus physical, the reality layer. This is where the narrative has to leave the screen, because paper markets and physical markets do not speak at the same speed. Paper clears, physical flows. Futures and derivatives exist to transfer exposure efficiently, which means they can reprice in seconds when balance sheets shift. Physical metal moves through inventory, fabrication, transport, and delivery. That takes time. It cannot gap. It cannot evaporate. It either exists where it is, or it has to be pulled from somewhere else. When stress enters the system, paper expresses it first through volatility. Physical expresses it later through friction. That friction shows up as changing premiums, delayed delivery, unusual sourcing behavior, and inventory draws that don't align with headline price. Tightness rarely announces itself with a siren. It shows up as inconvenience. Smaller lots, longer waits, region-specific shortages, spreads between what the screen says and what real metal costs to secure. This is why physical markets lag price but confirm structure. If futures collapse while physical premiums remain firm, that suggests liquidation pressure rather than abundance. If inventories stop rebuilding even as volatility rises, that suggests silent strain. Silent strain is what develops before price is forced to admit that availability and liquidity are not the same thing. You don't need narratives to see it. You watch whether material moves more reluctantly as paper moves more violently. Retail and wholesale channels often diverge here. Screens show speed. The real world shows resistance, and resistance is information. It tells you whether this is merely financial repositioning or the early stages of supply stress migrating outward. Physical demand is not reactive in the same way leveraged exposure is. It is slower, more intentional, and tied to long-term positioning psychology. That is why it matters in decision zones, because it doesn't chase, it absorbs. And with that layer in place, the analysis can widen. Now we map the three paths forward, and why only one of them is friendly to emotional traders. Scenario map, breakout versus fakeout versus washout. With the structure in place, the only responsible way to look forward is through scenarios, not forecasts, not targets. Scenarios. Because markets that have just expressed forced behavior rarely move in straight lines. They explore, they test, they probe where stress remains and where it has already been released. And those explorations usually fall into a limited set of paths. The first path is a breakout scenario. This would not begin with excitement. It would begin with stabilization. Volatility would compress rather than expand. Ranges would narrow. Correlations would ease. Dealers would tentatively re-expand balance sheets. Liquidity would slowly reappear. Pressure would build quietly as positions that were cut are not immediately rebuilt, and the market would start to move with less effort. In that case, strength would emerge not through speed, but through persistence. The confirming behavior would be improving breadth, firmer bids, and price moving without needing urgency. The invalidation would be volatility refusing to contract. The second path is a fake-out. After violence, reflex rallies are common. They feed on relief. They look convincing because the first move off the low is often the fastest. But mechanically, a fake-out is defined by weak participation. Spreads remain wide. Liquidity does not deepen. Correlations stay elevated. Price rises, but it takes very little to knock it back. In this path, stabilization never truly arrives. The confirming behavior is shallow retracement and renewed fragility. The invalidation would be dealers stepping back in and volatility compressing meaningfully. The third path is a washout then higher. This is the one that exhausts the most people because it requires a second round of liquidation. Margin sensitivity remains high. Volatility spikes again. Weaker hands finish transferring risk. But beneath that pressure, stronger balance sheets begin absorbing. You see it in price failing to extend despite stress. You see it in physical friction increasing even as screens stay violent. Confirmation comes from reduced downside efficiency. Invalidation comes from acceleration. Institutions adapt across these paths by changing exposure, not by narrating conviction. They reduce, they hedge, they wait. They add only when mechanics allow. These scenarios are not promises. They are conditional maps tied to behavior. And preparing for nonlinear outcomes is not pessimism. It is professionalism. Because the next section is about survival, not profit. And one mindset error destroys more capital than any crash. Risk, discipline, and positioning mindset. After scenario mapping, the work turns inward, not emotionally but structurally. Because volatility is not only a price phenomenon, it is an attention weapon. It is designed by construction to compress time horizons and pull focus down to the smallest possible frame. Every tick invites reaction. Every candle suggests urgency. That is not accidental. High volatility environments reward systems that force participants to shorten their decision loops. And shortened loops are where discipline erodes. This is why time horizon separation matters more now than analysis. If everything is watched on the same frame, everything feels like a threat. But different behaviors operate on different clocks. Funding stress moves on one clock, dealer balance sheets move on another, physical markets move on another. When those clocks are blended into one emotional stream, people begin to overtrade information instead of observing structure. Patience, in this context, is not inactivity. It is a position. It is the decision to let mechanics reveal themselves before responding. Overexposure breaks that patience. So does information addiction. Constant input creates the illusion of control while actually narrowing perspective. Reactive behavior feels productive, but it is usually just motion. Fear in these environments is not a flaw. It is a signal that leverage and uncertainty are present. What matters is not eliminating it, but preventing it from being translated into unstructured action. Physical asset psychology exists for this reason. It emphasizes durability over precision, structure over speed, and survival over optimization, not as advice, but as a framework. Rule-based thinking is what keeps participation aligned with reality rather than mood. Rules observe, emotion negotiates, and negotiation is expensive. Next, the real checklist. This is where clarity replaces scrolling. What to watch next? Signals? Checklist? With discipline in place, attention can move to signals. Not opinions, not forecasts. Signals. Because after forced behavior, the market always begins to whisper before it moves again. Those whispers are rarely found in headlines. They appear in frictions, divergences, and rule changes. Premium movement is one of them. Not the absolute number, but the direction and regional spread. If quoted prices move while real acquisition costs resist, that suggests paper clearing faster than physical flow. Inventory behavior follows. Draws that fail to rebuild or builds that stall quickly indicate that availability and liquidity are diverging. Delivery pressure belongs in the same category. Extended settlement windows and unusual sourcing patterns often precede broader recognition of strain. Open interest against price is another tell. If price rises, and open interest contracts, that suggests repositioning, not commitment. If price stabilizes while open interest rebuilds slowly, that suggests structure returning. Margin framework adjustments matter because they convert background stress into foreground motion. One small rule, change can alter who is forced and when. Volatility itself carries information. Compression after expansion often signals digestion. Expansion after supposed stabilization suggests unresolved pressure. Liquidity hours matter more than most realize. If markets gap during thin sessions and fail to repair those gaps during full participation, that indicates persistent imbalance. Correlation across risk assets belongs on the same board. When everything moves together, it usually means funding, not fundamentals. All of this is most relevant inside a narrow window. The next 14 days carry disproportionate informational weight. Not because they guarantee direction, but because they reveal whether the system is absorbing shock or multiplying it. Signals matter more than stories. Stories comfort. Signals prepare. Because one margin change could accelerate everything, and we may already be inside the transition. Interactive close, engagement, and cliffhanger. Before closing this briefing, it's worth returning to where we started. What just happened was not a shift in opinion. It was a mechanical event, forced behavior, rules asserting themselves through liquidity. That distinction matters, because it changes what deserves your attention. So I want to hear from you in the comments, not about what you think will happen, but about what you are watching. Which signal right now carries the most weight in your process? Is it volatility behavior, funding conditions, open interest, or something else entirely? And second, are you seeing any signs of physical tightness where you are? Changes in premiums, sourcing difficulty, delivery timing, or regional spreads? Those real-world observations often surface before screens agree. If these briefings help you stay oriented when conditions are unstable, consider staying connected. This channel is built around continuity, not reactions, around watching processes unfold, not chasing moments. Because one of the few genuine unknowns left is how the rule set itself responds from here. Margin frameworks, capital treatment, and liquidity access are not fixed. They adapt. And adaptation is what changes who is forced next. Your answers shape the next briefing. The system may not be done enforcing its rules. If we get another margin hike while price stabilizes, the next move could be faster than the last.